Most people believe gold and silver move because of prices, charts, or inflation numbers scrolling across screens. They think metals rise when fear rises and fall when confidence returns. That explanation is comforting because it suggests the system is still in control. But when nations move into gold and silver, they are not reacting to markets. They are reacting to trust. Trust in currencies, trust in payment systems, trust in the idea that money will remain neutral when politics turns hostile. Right now, that trust is being quietly tested. The world's two largest powers, the United States and China, are not openly confronting each other over metals. There are no speeches, no declarations, no official battle lines. But beneath the surface, their actions tell a different story. Gold has re-entered the center of global strategy. Silver, long dismissed as a relic or a speculative asset, is behaving like something much more important. This is not coincidence. For centuries, money worked because it was believed to be untouchable. You could fight wars, impose tariffs, exchange threats, but money was supposed to remain separate. That separation is gone. Financial systems are now instruments of pressure. Access can be revoked. Reserves can be frozen. Currencies can be isolated. When that happens, money stops being abstract. It becomes political. And when money becomes political, nations start looking for something that exists outside permission. That is where gold and silver return, not as investments, but as anchors. The United States built a world where trust flows through institutions and networks. China is preparing for a world where trust fractures and power must be held physically. This is the moment where metal stops being old-fashioned and starts becoming relevant again. The United States and China are not just rivals. They are operating on two fundamentally different ideas of what money is supposed to do. For the United States, money is a system, a web of banks, markets, bonds, and payment rails that connect the world into a single financial ecosystem. The dollar does not need gold behind it because it is backed by scale, liquidity, and confidence. As long as everyone uses it, everyone depends on it. That dependency is power. It allows America to finance deficits, stabilize crises, and enforce rules without moving a single soldier. Capital flows do the work. Markets do the disciplining. The system punishes those who step outside it. China sees danger in that design. From Beijing's perspective, a system that depends on permission can always be denied. A currency that flows through foreign infrastructure can always be blocked. Confidence is not enough when access itself becomes conditional. So China builds differently. It prioritizes control over belief, production over finance, assets over promises. Gold fits this philosophy perfectly. It does not rely on networks. It does not need approval. It cannot be diluted by policy or frozen by decree. Holding gold is not about profit. It is about independence. Silver extends this logic even further. It is not only a monetary metal, but an industrial necessity. It feeds factories, energy systems, electronics, and modern warfare. To secure silver is to secure the ability to function when systems fracture. America defends dominance through trust. China prepares for survival through ownership. These are not short-term strategies. They are long-term bets on what kind of world is coming next. And gold and silver sit at the center of that bet, silently, patiently, waiting for trust to either hold or break. China never announces its strategy when it matters most. It reveals outcomes, not intentions. That silence is often mistaken for passivity, but in reality, it is discipline. When China accumulates gold, it does not do so to impress markets. It does not frame it as a hedge, a trade, or a signal. Gold, in China's system, is something closer to a firewall. Over the last decade, China has watched how financial power is exercised in moments of crisis. It has seen reserves frozen, payment systems restricted, and currencies cut off from global circulation. These actions did not require war. They required access. That lesson changed everything. From Beijing's perspective, modern money is efficient, but fragile. It works beautifully when relations are stable. It becomes dangerous when relations sour. A nation that stores its security inside another nation's system is not sovereign. It is conditional. Gold removes that condition. It exists outside software, outside messaging systems, outside sanctions architecture. It does not ask for clearance, approval, or recognition. It simply exists. Silver adds another layer. Unlike gold, silver is consumed. It disappears into supply chains, infrastructure, and technology. It becomes part of the machine that keeps an economy functioning. In a fragmented world, controlling access to industrial inputs matters as much as controlling finance. China's approach is not about escaping the global system. It is about ensuring that if the system bends or breaks, China does not. This is preparation, not aggression. Insurance, not provocation. And insurance is always purchased before the accident. The United States does not think in terms of insulation. It thinks in terms of dominance. Its power does not come from what it holds, but from what others use. The dollar is not powerful because it is scarce. It is powerful because it is everywhere. Trade clears through it. Debt depends on it. Markets orbit around it. This creates a self-reinforcing loop. The more the world uses the dollar, the more liquid it becomes. The more liquid it becomes, the safer it feels. The safer it feels, the more the world depends on it. Gold, in this system, is almost unnecessary. Confidence does the work. But confidence is not static. It is behavioral. When financial infrastructure is used as leverage, the system changes character. What was once neutral becomes strategic. What was once universal becomes selective. America's advantage is scale. Its risk is perception. If nations begin to treat the dollar not as money, but as influence, behavior shifts subtly. Reserves are diversified. Settlement methods change. Metals return to balance sheets, not in panic, but in preparation. This does not mean the dollar is collapsing. It means the monopoly on trust is being questioned. Gold does not challenge the dollar directly. It waits. Silver does not attack financial systems. It embeds itself into the physical economy. The United States still controls the present, but the future is where preparation matters most. And this is where the quiet accumulation of metal becomes something more than a financial decision. It becomes a signal, not of weakness, but of uncertainty. Gold is static. It sits, waits, and preserves. Silver does not. Silver moves. It flows into factories, energy grids, electronics, and weapons systems. It disappears into products that power modern civilization, and once consumed, much of it never returns. This makes silver fundamentally different from gold. There is no large above-ground stockpile waiting to stabilize shortages. There is no central authority that can flood the market in a crisis. Supply grows slowly, constrained by geology and economics. Demand grows with every technological leap. That imbalance creates vulnerability. For decades, silver was treated as an afterthought, a byproduct, a speculative metal sitting in gold's shadow. But modern infrastructure changed the equation. Solar energy, electric vehicles, advanced computing, and precision weaponry all depend on silver's unique properties. This transforms silver from a commodity into a strategic input. In a world where supply chains are weaponized and trade routes are politicized, control over industrial materials becomes leverage. The nation that can secure consistent access does not fear disruption the same way one that cannot. This is why silver matters to both China and the United States, not as money, but as continuity. Gold protects sovereignty, silver protects functionality. And functionality is what keeps power alive when systems fracture. Most discussions about gold and silver end with a number, a target, a prediction. That focus is misplaced. Prices are not causes, they are consequences. What truly moves metals is behavior, the behavior of governments, institutions, and systems responding to uncertainty. And that behavior is changing. Central banks are diversifying quietly. Trade is becoming regionalized. Payment systems are being redesigned with political risk in mind. None of this happens overnight. It happens through small, rational adjustments that only look obvious in hindsight. Gold does not rise because people are afraid. It rises because institutions are preparing. Silver does not fluctuate because traders speculate. It moves because physical demand collides with limited flexibility. This is why price volatility tells an incomplete story. The real shift is structural, not emotional. The world is not abandoning existing systems. It is hedging against their limits. When trust is absolute, paper is enough. When trust becomes conditional, reality matters. Gold and silver do not promise returns. They promise relevance when assumptions fail. That is why they sit quietly in the background of a changing world, not announcing collapse, not predicting crisis, simply positioning themselves where trust is no longer guaranteed. It is tempting to frame this as China versus the United States. Two flags, two ideologies, two rivals competing for dominance. But that framing misses what is actually happening. This is not a conflict between countries. It is a conflict between systems. One system is built on speed, liquidity, and belief. It moves capital across the planet in milliseconds and governs behavior through incentives, access, and markets. It thrives when the world is connected, predictable, and cooperative. The other system is built on insulation, redundancy, and physical control. It assumes friction, division, and instability. It prioritizes ownership over access and preparation over efficiency. Neither system is irrational. Both are responding logically to a world that is becoming less stable. Gold and silver are not weapons in this conflict. They are symptoms. They appear when systems begin preparing for scenarios they hope never arrive. No nation is trying to destroy the global financial order. That order is too valuable. But every major power is preparing for the possibility that it no longer functions as smoothly as before. This preparation does not show up in speeches or headlines. It shows up in balance sheets, reserve composition, and long-term planning. Gold waits outside the system. Silver embeds itself within the physical economy. Together, they mark the fault line between trust and control. History rarely announces its turning points. They are not marked by sudden collapse or dramatic confrontation. They are marked by quiet decisions that seem insignificant at the time. A small change in reserve policy, a new settlement agreement, a slight preference for physical assets over promises. Gold and silver do not force these changes. They reveal them. Years from now, analysts will search for the moment the world began adjusting its definition of money. They will debate causes, assign blame, and construct narratives. But the truth will be simpler. Trust became conditional. When that happens, systems adapt. Power hedges itself. And reality reasserts value over abstraction. The United States will not disappear. China will not replace it overnight. What changes is the foundation beneath them. Gold and silver do not predict the future, they prepare for it. They do not collapse systems, they survive transitions. This is not the end of an era. It is the beginning of a quieter one, where power is measured not just by influence, but by resilience. And when future generations look back, they will not ask when the battle began. They will ask why no one noticed it happening.